This is Going to Zero. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, world leaders are in panic mode as fears of an imminent currency collapse escalate. And while many people think it's the dollar going to zero, we'll make the case why there's a lot of other currencies that are about to fall, and world leaders are scrambling in a big way. I'll show you what they're doing and just perhaps how soon things can come unwound. But that's not the only thing going to zero. We're going to take a look at the U.S. banking system as now new risks show that something nobody thinks that's about to collapse will make the case of why it's headed to zero too. Now let's over to Bloomberg, where we picked today's story up with a headline as emerging currencies slump to a 3-month low on flight from risk. And this is exactly what we talked about in yesterday's show, and we're seeing it already start to happen as the dollar builds strength here, as everyone starts to look around the world and realize it's not just a European central bank that's cutting rates or is going to be cutting rates in 60 days. It's a lot of other central banks that's putting downward pressure on currencies in a major way, is putting world leaders in such a predicament. They're doing something that even they didn't think they'd have to do. And today is about risk aversion driven by an escalation in the Middle East. You're seeing a lift for the safe haven currencies such as the dollar and yen. Of course, we know the yen is just not in great shape, which in turn is weighing on the emerging market currency complex. And this is, of course, driving price of emerging currencies down in a big way. And this just leads to a big destabilization of the global economy that many people don't understand, that these currencies need to be fairly close together. You get these big gaps, and next thing you know, stress starts to show up in the global financial system. In fact, the global repricing sparked by the U.S. price growth data, referring to the CPI, released on Wednesday, continued amid additional fears of a direct confrontation between Israel and Iran as soon as Saturday. Separately, the intensification of Russia's attacks on Ukraine are stoking worries that Kiev's military efforts was nearing a breaking point. And so what we're seeing here in the market is belief that the dollar goes higher, and this is driving money into the United States, into the dollar, into dollar-denominated assets such as equities, such as bonds, such as gold, and you're seeing this happen. Now, in the scope of the global economy, something that is very, very important to understand is the United States needs to export dollars around the world. That is the grease that puts on the wheels of the global economy. We need to see dollars heading out of the United States, flowing through it, and instead we're seeing money flow in. This is a dangerous sign that's telling us that these weaker currencies are going to be the breaking point of the global financial system. And evidence of that is further as we take a look over to China, as dollar gets costlier to borrow in China in new sign of yuan woes. And there is, again, validation of the point I'm making is we need dollars for global trade. Now the cost of those is going up. This, of course, means that other countries are going to want to get away from the dollar. The problem is their currencies are losing value. So when they say, hey, let's trade in yuan or something else, and people are going to say, not a chance, I want dollars. The problem is the cost to get them is rising. This is not, again, a good sign at all for global trade, as the tightening supply of the U.S. currency in China has coincided with the dollar's global rebound this year, which is threatening to go even higher as a series of upbeat economic data weaken the case for the Federal Reserve to cut interest rates. If the trend persists, Beijing may have to resort to a familiar tool to ease dollar liquidity as well as pressure on the yuan. Now, of course, the question we're going to be asking is, what happens when they run out of those tools? Of course, we know what that means. A devaluation is eventually coming, but in the meantime, in a bid to defend its currency, China has slashed the ratio that sets the amount of foreign currency deposit banks need to hold as reserves 3 times since 2022, with the last reduction in September. Look for more of this to happen, but just think about this. If they are draining their foreign currency reserves, what happens when they have none left to drain? That indeed is the issue here. And since China's central bank has mostly relied on a strong daily reference rate or fixing and dollar sales by state lenders acting as its proxy to alleviate pressure on the yuan. After falling below a key support level in late March, the Chinese currency has extended its drop onshore to a 5-month low against the greenback as signs again of further divergent monetary policy get to further and further extreme levels at a time we continue to see slowdowns in the global economy and demand for these other currencies get weaker and weaker. However, there's only so much Beijing can do in the face of the dollar's global strength, which is true. And while China might consider more tools to support the yuan, they can only help to slow the depreciation pressures as we have seen in the past and buy time until the broader market forces shift or fundamentals improve at home. And this is exactly what we've been making the case, is that demand for the yuan will not improve until the global economy rebounds. And all China can do, all Beijing's attempts here, just slow it down. The challenge now is the dollar's starting to rally. More money is going to leave other parts of the world, particularly if the ECB pulls the trigger in 60 days, as we believe they will. And that's sending, of course, world leaders in panic mode and doing something that even many people, even they did not think they'd do. And of course, you know what that is. That means they're buying gold in a big way as China's PBOC now for the 17th straight month as a buyer as prices hit the record high. And many of you are saying, man, I wish I would have made that gold trade. I wish I would have known. But the answer is you could have known because our subscribers did. Let me show you this. This is going back on November 12th of last year. On GLD, we showed you the machine positioning was max short. Here's a screenshot. It was max short coming off that signal. That was the first one. This is our CTA report. This looks at the machine position. Told you the machines were max short. They were flipping. That was your indicator to buy. If you had a pair trade and signed up for a Momentum Timer Pro report that looks at all those technical signals, but instead of getting you in late and out early, we smoothed it out with a proprietary overlay. It was flipping off a mid-sized sell signal on the monthly to a buy signal. You would have spent, if you had both reports, had double confirmation, $550 for the whole year. And right now on that trade, on $5,000, you'd be at $1,314 or over 26%. Here's the best thing. We put a 30-day free trial on both of them. My friends, I only do 7 days. You can't make money in 7 days, but believe me, we'll show you some major trades over the course of a year to put money in your pocket. You can be a professional gold trader just on that alone. But how about this? Global central banks playing chase. You could have been in first. That's what we're trying to show you. Led by China and India, continued adding to their gold reserves in February, marking a 9th straight month of growth, according to the World Gold Council. However, the figure for February showed a 58% decline from the previous month, stemming in part from higher volume of sales. So here we can see central banks around the world looking to protect their currency. And that's how you know that things are far worse than what they're telling you. They're trying to prop their currencies up, and internally they're saying, you know what? It may not work. So what do? You go buy a whole bunch of gold, could send gold even higher. There's something else, though. I talk about going to zero. There's other trade opportunities. If you miss this one, it's okay. You want to play chase, you can do that too. But gold prices are up again this morning as more investors view it as a better hedge against geopolitical risk than government bonds due to U.S. inflation concerns. Well, that is until U.S. inflation actually comes down. In fact, what gold is actually telling us, when you might be surprised, I'll show you on the next chart here, the rates are actually going to zero. Just as I said, here, what we see here is the 7 to 10 year Treasury bond fund symbol IEF, this in the kind of green and red candlesticks, against GLD. Here in purple, here you see GLD just racing to new all-time highs. What does that tell us? You notice they move in sync. What is it saying? Is interest rates are coming down in a big way. The Fed doesn't know it. Most people don't know it, but what it's telling us is if gold is rallying, it tells us the global economy is in serious danger, and that means rates are coming down. And as we look to the U.S. banking system now, we'll have further evidence that this is indeed what's coming. As JP Morgan shares fall after a miss of higher expense guidance on their net interest margin here, what we're seeing is they hauled their haul into the streak of 7 quarters where it posted record levels on the metric. The CEO, Jamie Dimon, cited deposit margin compression or tightening of profits between what the bank earns on loans and pays out on deposits, and lower deposit balances in the consumer business for the sequential decline. Now, I want you to frame this as that chart you just saw of gold and bond prices. And many people, I know I read the comments, they tell me all the time, no, interest rates need to go higher. We've seen articles on the show where people say rates have to go higher. And I want you to look at the data now and make the case why rates have to go lower, or the U.S. is headed for an all-out financial crisis, irrespective of what happens in the rest of the world. Let's take a look at the evidence, because first we talk about corporate profits. Everyone's piling into the U.S. equity market as a safety trade, believing profits go up. But let's take a look at commercial industrial lending here. This is the weekly data showing on a year-over-year rate of change. And what did Jamie Dimon just say? That, hey, we're seeing a problem in the lending space. Well, look at these decelerations in lending. Again, what happens? Corporate profits go down. Everyone right now says corporate profits only go up. Lending says they go down. And why is lending tell us going down? Because companies aren't demanding loans. When they don't demand loans, that means they don't need money. If they don't need money, it's because they're not selling a whole bunch of product, moving product around. They don't need the money. Of course, the further evidence of this is we look into JP Morgan's data. What do we find? That charge-offs were nearly $2 billion, up $1.1 billion from a year ago, still below estimates of 2.2. What are charge-offs? That means the bank has realized they cannot collect on a loan. Those are losses the bank eats. And sure enough, we know that's going to get even worse, because we made the case in the show that what happens is you need new loans to pay off on old loans. That's just how the world works, particularly in a debt-based society. And you can see that evidence very clearly here. Again, keeping with the commercial industrial lending data, that in blue, against the delinquency rate. And you can see as there's a slowdown in lending and eventual contraction, you notice the delinquency rate goes up, because so often what you see is, say someone sells their house. Well, the new buyer takes on a new loan. So an old debt paid off with new debt. This is just the nature of how world works here. And what you can see is these decelerations and contractions lead to an increase in delinquencies. Bad news for the banks is here we are in a very mild contraction in an early stage. Delinquency rates, we know, headed even higher. But let's keep digging, because it wasn't just JP Morgan that is suggesting now that rates need to go to zero, because how do you fix a slowdown in lending? I want you to be thinking this. How do you fix the delinquency rate? It's not higher rates, because if there was a demand for higher rates at this point, we would see lending demand grow. We would not see delinquency rates rising. Let's take a look at Citi profit beats as companies, consumers on borrowing bins, and that's dangerous because consumers have been falling behind due to inflation, and look what they're doing. Credit cards drove growth in the U.S. personal banking space, boosted by more spending as well as larger interest generating balances on cards from partnerships such as Home Depot. We know store cards generally get defaulted on first, and this is the case where we're seeing a slowing economy. Consumers piled up on debt thinking that they're going to get ahead, believing the second half rebound. Well, it's not coming at all, at least not based on the banking data. And here we see Wells Fargo net interest income misses estimates as depositor pressure grows. And this is, again, looking at the banking data. It validates everything about where rates are headed. What gold is telling you about the bond market, as Wells Fargo attributed the decline in the first quarter net interest income to the impact of higher interest rates on funding costs, including customers moving their money to higher yielding accounts, which for a long time they didn't care. They wanted them to leave. Well, now that they're changing, and here's the other part, as well as lower loan balances. So many people say, well, I want higher rates. Rates need to go even much higher. This is a big problem. But when you look at a debt-based economy, it's all about the lending space. So when loan demand goes down because rates are elevated, it doesn't tell you that rates need to go higher. Because if rates go higher, it's not that people are saying, well, you know what, I was going to borrow 5%, but now that they're 8, I'm going to go out and get a loan. No, if they're not willing to borrow at 5, they're certainly not going to borrow at 8. And that is the key thing here, is that rates need to come down. And here we can see that from Wells Fargo's lower loan balances as people choose to continue paying down instead of taking on new money. In fact, you can see it evidence in this chart here that rates are now becoming very restrictive. When we look at commercial industrial lending against 2-year treasury yields, and what do you see? Yields here rising. What happens? Yields get too high back in the mid-90s, leads to a deceleration in lending. You see it happen again here going into the global or the dot-com bubble. Rates rise, that leads to a deceleration in lending. You see that slowdown happen around 2006, near going into 2008, before, of course, the government starts playing its magic games, and that leads to at least a transitory increase in lending. Look at this. How about going into the pandemic? Remember, the Fed was cutting rates here. You see around late 2018, 2-year treasury yields peak because lending demand was starting to decelerate. Here it's contracting, and what is the popular belief is that rates only need to go higher. Well, if they do, that leads to, of course, less money creation. In fact, it leads to more money destruction. In a debt-based economy, you continue to destroy money. What happens? You don't have enough money to pay on all the debts, which is becoming very evident, and you don't have enough money to continue the growth of the economy. Next thing you know, you get a lot of layoffs, you get a lot of defaults, and the whole banking system comes under fire in a big way. This is a dangerous sign. Why, again, we make the case that rates need to head lower. In fact, the San Francisco-based bank reported $1.15 billion in net charge-offs. Here again, showing that people are not paying their bills, including $187 million, which is a very small amount, tied to commercial real estate. Keep in mind, we haven't even started the commercial real estate crisis. That is going to be devastating for the banks. Now, typically not for the big banks like JP Morgan, Citibank, Wells Fargo, because they didn't do a lot of commercial industrial lending. But who did all this commercial real estate? A lot of small, mid-sized banks, which are insolvent in a big way. Again, you continue to look at what gold is telling you. It's that rates are going to zero. In fact, what we see here is that the firm's commercial property portfolio looks pretty good in most cases, but warn that issues in the space will take time to play out. When they do, when those dominoes eventually fall, watch out below, because what it's starting to see now is consumers are under pressure from higher rates, as you're about to see. As U.S. consumer sentiment slips on dimmer view of inflation outlook, and it's not just inflation, it's the economy here, because when consumers feel they can't get ahead, they've been borrowing like crazy and they're not seeing, of course, their incomes rise, their hours worked increase. That means sentiment starts to fall. When sentiment goes down, people spend less, so you see lower corporate profits, and then, of course, that means more layoffs, more delinquencies. It all comes full circle, as the decrease in sentiment coincides with rising gasoline prices that now stand at a 6-month high. And this is a case we've been making here for a while, that consumers can't afford higher energy prices. You see it right here in the University of Michigan Sentiment Survey, saying, wait a minute, this is an issue that all means less discretionary spending on the other side of the balance sheet for consumers. They also say elevated prices and high borrowing costs are keeping sentiment well below pre-pandemic levels. And sure enough, what do you see here? Let's just talk about this from a yield perspective. You can see that when yields get too high and consumers are finding themselves unable to get ahead, they can't borrow, they can't spend, and their sentiment starts to drop, yields fall. You see that here again, yields going too high, consumers under stress, yields come down, sentiment comes down. You see it here at dot-com bubble, same scenario. Global financial crisis. Again, now what happened is we know sentiment fell. Rates did not. Everyone said rates need to go higher, including the Fed. Now sentiment's starting to reverse. Again, making the case why rates need to head lower here, and in a big way. Who could you imagine that gold was signaling that rates are going to zero at a time when virtually nobody sees that happening? Everyone's bullish on gold, but soon they'll be bullish on bonds as well. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.